Hello and welcome to this short video on warranties. So in this video, I want you to imagine that we work for a company that manufactures and sells computers. And of course, for those computers to be sold, people want warranties on those computers. So definitely applicable. And, with any company, we are going to have an income statement. So, if we sell all these computers or a whole bunch of computers during the year for $280,000, we know that there's going to be a cost associated with all the computers we sell. There's going to be warranty expense. Now, the problem is if we're looking back on the year that we sold the computer, and we have like a 1 or 2 year warranty, a lot of those costs are going to come into the future. We're going to pay for those warranties, to get those things fixed in the future. So that means in order to match this expense with the revenue it helped to create, that matching principle, we are going to have to estimate it. And that's how we'll calculate our net income. On the other side, our balance sheet side, we're going to owe a certain amount of money to get these products fixed. So again, to report really what the company owes, we've got to come up with a cost for all those warranties that we'll need to pay for in the future. So we're going to pop over to exercise 9-6B and see how this works. Okay, so Steve Owens, he sells computers, and so in this question, we're asked to journalize the transactions for this company and post them into the T account. So that's how we're going to start. So right off the bat, transaction number 1, he's going to buy some computers for $150,000. So we're going to have inventory going up with a debit of $150,000. We're zero. A lot of computers, and we're assuming he's paying cash of $150,000. All right. So we got to assume that he had some cash in the bank account in order to do that, but whatever. Maybe he bought them on account. I don't know. Doesn't say that, so we're just going to assume cash. So there we go with that transaction. And then number 2, he is going to sell those babies. So sold them for $280,000 cash. Woo, I love cash. So cash is an asset. It goes up on the debit side, and then we're going to have sales revenue of $280. And revenues are always credits, so we're going to credit that bad daddy. That sales revenue goes in credit side of the T account. Woo! My cash goes up by $280. Yay! Now, oops, I forgot to post my purchase. So that's the purchase of inventory. Now we've got to sell that inventory. It's going out the door with our customers. So I will need to debit my cost of goods sold for the cost of all those darn computers. So all those computers cost me $150,000 to buy, and my inventory is now going down with a credit. Bye-bye inventory. That has just been subtracted out of that account. That asset is gone, because it's sold to our customers. Woo, woo. There, it gets put in that category. Cost of goods sold. Cost is just transferred from the asset to the expense when it's used. Now, we know that part of making that sale is providing warranties. So all those sales, he has to provide warranties on them, but that's going to be in the future, and we don't know exactly how much that warranty is going to be, so we're going to guess. So the first account will be warranty expense, the cost of providing the warranties for the computers, and our warranty payable, what we will owe to provide those warranties. So basically it's company history or industry standards. Whatever it is, you're going to be told in these questions. We're not going to get into estimation methods in this course, but you need to understand how accounts work and why they're there, and warranties are important, so this is part of it. So here we go. If it's estimated that the warranty will be 5% of sales, I'll just take that sales amount and boom, times it by 5%. Hot diggity darn, $14,000 in warranty, and that is what I can expect to pay for those warranties. So I am adding to my warranties payable with a credit, because that's just how liabilities account works. And expenses are always debits, so this bad daddy's going to be an expense. Now, last but not least, we have a computer that comes in. We got to replace that darn hard drive. Ah, darn. Well, I've already set up that warranties payable. So this is just how I pay it off. I fixed those darn computers that have gone wrong. So, oops, too bad I cannot spell warranty. Anyway, so at this point, you debit a warranty. Well, you always debit a warranty when you pay it off. So I'm paying off $1,545 worth of that warranty, fixing the computer for the customer, paying to get that customer's computer fixed with cash. So what goes into the warranty goes out when you pay it off. So now we'll see at the end of the year, that's how much is left to go. Subtracting out of our cash account. So if we balance that cash, have that's the total of my cash account. All right. So now in the question asks us to post the preceding transactions into the T accounts. Done. Prepare an income statement and statement of cash flows for Steve's first year in operation. Well, there's my income statement. Our revenue, cost of goods sold, less our expenses to calculate our net income. All right. And, well, statement of cash flow, I'm going to be a little bit lazy here. I'm not going to do it because I just got my cash account here. My cash from all these transactions is significantly higher than my net income. It's a different number. And that's because just looking at cash does not tell you the whole picture of what's going on in the company. And that's why we need all these different statements. So let's think about our income statement. We made all these sales. And yeah, some of the warranty claims came in during this year that we would have made the sales. But you got to think, if we made sales all through the year, and here we are at the end of the year, well, if we made sales in December, those computers are still going to have 11 months of warranty. We're going to have a bunch of claims on those computers like into next year. So there's going to be a cost to those sales that we actually need to pay for into next year. And we're capturing that cost in this year so we can more accurately report how much we made on those sales. Now, yeah, that is based on a guess, but that's okay because guessing is better than nothing. And it's an educated guess, so we're not going to be that far off. On the other side, we've got our balance sheet, and we need to show, hey, due to all those sales, we're probably going to need to pay up, well, this amount of money now that we've paid off some of it. But, you know, we need that full picture of the company that we just don't get with our cash account. Not to mention, like, we don't have any inventory left. Weirdest company ever. When we bought our inventory, there should probably be some sitting here left over if it was a normal company. So you're really not going to get the full picture of what's going on with the company by just thinking about cash. That revenue recognition and expense recognition principle, super important to get the full picture of the income statement. All right, hope this video helps. Have a great day.